Afro Senpai here. Today's video is going to highlight exactly why everybody needs to have some sort of background in financial literacy. I'm talking with a potential financial advisor from Personal Capital, and had I known nothing, I might have taken them up on the offer. Because I started my own wealth building journey, I wasn't having it. Enjoy.
Awesome, man. Well, hello. I'm real. I'm in Denver. It might be a little small on the phone, but we'll make do.
Yeah.
But excited to get together here and start talking about, the review. Any questions before we get going?
No.
So we have an analysis of the existing portfolio. Do you have an understanding of what it means to work with a fiduciary as opposed to a broker?
Yes.
Okay. Well, quick, simple recap.
I like how he didn't believe me and he felt the need to recap it for me, but we've talked heavily in previous videos about what a fiduciary is. It's basically somebody who's looking out for your best interests and not trying to make a profit off of you.
We don't make any money from the dashboard. We don't make any money from the trading or the commissions or anything like that. The only way we make money as a firm is the 0.89% that we charge. But I just wanted to see if you had any questions on Personal Capital.
The 0.89% is your expense ratio for your smart weight fund?
Yeah, so it's not a smart weight fund. 0.89% is it's the management cost. So that's the expense ratio for us handling the fund.
Another topic we talked about in previous videos, I don't mess with people who have expense ratios above 0.1%. If all they're offering me is things that I could find in the S&P 500.
So there's nothing extra additional on top of that, other than the ETFs that we use carry a very, very low cost expense.
What's the expense ratio on those?
Yeah, like 0.07. What we're seeing from this number is that people are really happy with what we're doing based on what we're charging.
I bet they are, because they don't know that they're being bamboozled.
So all right, let's talk about the meat and potatoes. $1 million. By 40. That's the goal. You're saving around 25,000. Based on the next 5 years, we're basically, going to have to come up with it 3 times out of nowhere. That I guess I suppose that's possible. That being said, we'd rather you get to $1 million in appropriate time with the appropriate risk tolerance, because, obviously we talked about the portfolio last time, but if anything happens to Tesla, then we're not talking about $1 million. We're talking about getting back to 200,000.
Part scare tactics, part reality on his part. I mean, anything can happen to any company. I just believe with what Elon and Tesla are doing, they're literally changing the world, and that cause is going to be protected.
At the top right is your allocation. All right. Well, is there anything here that's a surprise to you?
Let me try to zoom in here. I don't think so.
Yeah. I mean, as you know, you're betting the family farm, that $1 million goal on one company. The question are these already large companies that you're holding going to double or triple in size? So to get you to that million, we want to have a wider net cast between the mid and the small cap companies. We're going to suggest a 60-20-20 split.
He's referring to 60 in large cap, 20 in mid cap, and 20 in small cap companies. So here's the breakdown of small, mid, and large cap companies.
Otherwise, it's going to be difficult for these already large companies to grow at the pace that you want them to. Ultimately, I don't think that I'm going to convince you to get out of Tesla entirely today. So we're going to recommend balancing out the sectors across all the ones that you're missing. Consumer cyclicals has had a really good run this year, almost amazing, between Amazon and Tesla, but actually it hasn't beat tech. Tech has done better. So, we want you in the best sector regardless of what's going on.
Okay, so Personal Capital is assuming that Tesla is a consumer cyclical company. To categorize Tesla as just a car company is short-sighted on their part, because they do so much more stuff than just make cars.
Let's try to find a little bit diversity.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses.
Diversification, that's for idiots, right? Because you can't diversify enough to know what you're doing.
I don't believe in diversification at all. I would own one stock if I could find one great stock. Diversification is a big mistake. I call it diversification.
Much of what is taught in modern corporate finance courses is twaddle.
I don't think that we want something like this happening in your portfolio, especially as fiduciaries.
So this is super misleading because they're saying, hey, look at what happened with tech. It crashed over 80%. But that was the dot-com crash, and then it roared back up following that crash. Somebody who's not understanding the market or not understanding the history of recessions would look at that and say, oh my gosh, I need to do what they're telling me.
I'm very passionate as to how we do this. I've seen the testament to the growth, but in-house here, but ultimately going from the outside in, how does it look to you?
You guys returned 11% were smart waiting for the last year, or what was your percentage return?
Yeah, so the YTD is going to come out in January, but right now, yeah, it's been kind of 11% per year. That's before the fee, meaning after the fee, it's around 10.2.
So after the expense ratio is factored in, they're getting 10% on their return, which I cannot have if my plan is to become a millionaire within 5 years. That's right on par with the market.
Like the Washington State plan, you know, pretty conservative. I know it's not that much money, but it's really not lining up with the methodology of the rest of the portfolio. And it might have just been some fund that you clicked on, but we just want to make sure that, look, you know, you're an aggressive investor. This 7,000 is not going to grow with 30-40% in bonds.
So my Washington State retirement portfolio looks more like an all-weather fund, so it has stocks, alternatives, and bonds. And he's correct, it's not aggressive, but this is to protect against the coming recession. Once the recession is over, I'll switch into a more aggressive all-stock sort of situation.
But ultimately, my opinion doesn't really matter. You know, it's your financial life. You're the CEO. We're only the CFO. We can only advise. What I would say is, I know that you enjoy doing it a bit. And we'd love to really effectuate something here with you. How do you feel about that?
I think I'm good where I'm at, and I'll just keep doing my own thing. But I appreciate the work that you're doing.
Yeah, for sure. Ultimately, I know that's a lofty goal that you have, but Tesla's already a $500-600 billion company. You know, I think betting on a single stock to get there, yeah, it's kind of like swing for the fences or die trying. But you know, yeah, I mean, I'm not sure if you're.
I'm not opposed to working with anybody, but like if you're doing like 11% returns with a 0.89 expense ratio, I don't see the value.
Yeah, I mean, certainly can understand that.